Good evening, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to this evening's webinar. Tonight, we're going to be looking at a specific topic, but we're going to be splitting up the topic into two halves. We're going to be looking at trade journals. Now, there's a lot of videos and a lot of educators who are talking about trade journals, and there's a lot of webinars about trade journals, but it's basically looking at the definition of what is a trade journal. If you want to put a trade journal together, how do you put a trade journal together? But in my opinion, the important thing is, ladies and gentlemen, is to learn how to improve your trades, how to improve your success rates, how to become a more knowledgeable trader, a more confident trader. This is what is important to, of course, any educator, and it's the most important thing for anybody watching today's webinar and traders in general. So today, ladies and gentlemen, we are going to be looking at a trade journal. We are going to be looking at the very basics of the trade journal, especially for traders who have never traded before or are very new to the market, to get a good idea of what is a trade journal, how to form a trade journal. But I'm not going to spend too much time on this. What I want to look at is how you can use a trade journal to be more successful, to increase your success rate, to increase your reward to risk ratio, to be a more knowledgeable, a more confident trader. This is what I want to concentrate on. And yes, like I said, we're going to start off with slightly more basics, but we're going to go after 2-3 slides into looking at these different factors. For example, a lot of people say to me, in order to be a successful trader, I have to be able to determine how the price is going to move. And yes, ladies and gentlemen, to a certain extent, yes, you do analyze the market, you are evaluating the price movement, and you are attempting to determine how the price is going to move. But I will tell you as part of this webinar that no matter what your success rate is, any trader can be a successful trader, no matter what your success rate is. So for example, if you've got somebody who's got a 90% success rate, he can be an unsuccessful trader. He can be in a loss every single month, even though he has a 90% success rate. So for example, out of every 10 trades, 9 of those are in a profit. And the same thing applies to somebody who's unable to determine how the price is going to move. Let's say somebody who's only correct 30% of the time, or 40% of the time, or 25% of the time, they can still be successful. And it's all about putting together the right trading plan, and more importantly, having a trade journal. And I'm going to show you how you can use your trade journal to make sure your trading plan is correct, your reward to risk ratio is correct, your success rate is correct, and also how to connect your trading plan to your real trading. So looking at your trading plan and how to look at your trades and your trade history and to pinpoint what needs to change. So after the end of the week, you look at your trades, you've opened 20 trades, for example, and you're able to look at them and say, XYZ happened, this is what went well, this is how to determine why certain things went wrong, and this is how I'm going to trade, and you're using your trade journal, how I'm going to trade the way I'm trading in order for next week and the week after and so on and so forth to be more successful. Now, before we start looking at this, ladies and gentlemen, we always start off with 2 slides, just a very quick introduction. Now, as part of these 2 slides, I want to look at 2 things. The first thing is everybody needs to understand that here we're looking at an investment. Now, as with all investments, no matter what it is you are trading, if you are trading, for example, currency pairs or commodities, whatever it may be, they are all investments. As with all investments, there's a certain level of risk involved because we, of course, have no control over how the price is going to move. And of course, you take full it's fully your decision on, of course, how to trade as well. So it's important that we understand this, that we're comfortable with this before proceeding to a full investment. The second thing I want to say as part of this slide is these webinars are not here to give financial advice. But of course, what we do want to do is give as much educational material as possible in order for you to be trading with confidence, with knowledge and expertise. And I can already see some questions, but this is also, ladies and gentlemen, a great opportunity because yes, everybody has an account manager, but it's also a great opportunity where you can actually ask questions to an analyst and get the questions answered live. And I can already see some people have asked questions. We will look at those questions. But just so everybody's aware, there is an option on the GoToWebinar software to ask the questions live. This is the last slide as part of the introduction, then we'll go straight to looking at trade journals. A little bit about my background, because I do think it is important to know a bit about the individual who's providing you with this information. Like I said, my name is Michalis. I am one of the market analysts here. We have a very large team of market analysts, which are based all around the globe and different financial centers. A bit about my background. I've been in the market now for 10 years. Originally started off as a financial advisor. I've been a market analyst now for just over 5 years. Like I said, I've been trading and investing for 10 years now. I don't want to spend too much time on this slide. I just want to give people a bit of information, especially for individuals who have not previously watched one of my webinars, because it is important to know a bit about the individual who's providing you with this information. So let's start by looking at the basics. Okay, what is a trade journal? Today, like I said, we're going to look at two sides of trade journals. The first thing is, what is a trade journal? What is involved in a trade journal? The second thing is how to use that in order to be a better trader. Okay, because there's a lot of, like I said, there's a lot of videos, there's a lot of educators online on YouTube where they say, you know, this is the relationship between interest rates and inflation. This is the relationship between the Federal Reserve and the stock market. And they'll give you the theory, but how do you personally today use that information, again, to better you and to better your understanding of the financial trading markets? This is what we're going to be looking at in the second half. So first things first, what is a trade journal and how can it help us improve trading? Let's look at the very basics of this. So everybody who is active every single week, at the end of the week, they should be completing their trade journal. A trade journal is a report which will confirm what you have traded, at which prices you have traded, when you closed the trade, when you opened the trade, and of course, in that period, okay, whether the trade is still open or if it's closed, how much profit have you made, or if you're making a loss or made a loss, what was the loss? This is what is known as a trade journal. Now, all institutional and professional traders will have a trade journal because they'll monitor this, and this trade journal will actually give them the information they need in order to determine different aspects of their trading. They can help it, they use it to help them understand the market condition, they use it to help them understand the trend, the price sentiment, and of course, most importantly, how to change their trading and the way they're viewing the market. But very simply speaking, what is a trade journal? A trade journal is just a journal. It is just making notes of everything that you have done in a week. Now, somebody is a scalper, for example, because we've got a lot of scalpers, which is basically an ultra short-term trader, and he is opening 500 trades every single week. We've got a lot of these individuals. Yes, I do understand that doing a trade journal can take some time. However, if you do it on Excel, for example, it can be done very easily and very quickly. But most people who are watching today's webinar most likely is a beginner. And most likely they're not opening 500 trades every single week. So these individuals, ladies and gentlemen, have no excuse at the end of the week on a Friday before the market closes to sit down and say, these are the trades that I've opened for this asset, these assets, if it's more than one asset. These are the prices that I opened them at. I was trading short, I was trading long. This is when I closed them, and this was the profit and the loss. And like I said over here on point number 2, institutional traders give a lot of attention to monitoring what happens before they're opening the trade. So it's not just about when the trade is open. It's not just, you're not writing when you open the trade, so you know when you opened it, what you're going to do is you're going to, and this is something, keep in mind that all these YouTube videos, which a lot of the time are just rubbish, they're not giving, they look at the theory, but they're not giving anything which is actually helpful to the trader. You know, these individuals will say to you, you have a journal because you will monitor your trades, but it's not about solely, the important thing isn't monitoring the trade. The important thing is going back and seeing what happened before you opened the trade and what happened after you opened the trade. This is the important thing. This is, yes, it's important for different reasons to be noting the trade, but the most important thing is going back and looking at what happened before you opened and what happened after you opened, because it's at that point that you're going to get a good understanding of how ideally you need to change the way you are trading in the market if you need to trade the market. So certain things that we're going to be looking at, and some things you need to ask yourself when you're looking at your trade journal is, when you're looking at that trade that you opened a couple of days ago, should you have opened that trade earlier? If you should have opened that trade earlier, how can you look at the strategy slightly different and would have used a certain setup in order to open that trade earlier? And we're going to look at this in more detail. Something else that you could have asked yourself is, when you close that trade, should you have closed that trade earlier or should you have closed that trade later? Now, one of the main, and it's something very simple to do, one of the main important things to do in terms of looking at the trade journal is to confirm your success rate and reward to risk ratio. We're going to look at this in more detail. This is also referring back to what I said at the very beginning of the webinar. When you're looking at trade journals, it can show you that even though you are unable to determine how the market is going to move, for you still to be successful. This is the difference. This is what's going to make the difference. Looking at the mathematics behind trading. So whether you are very successful at trading, you've got a 90% success rate, or whether you're not successful at all and you have a 25-30% success rate, what reward to risk ratio do you need to be profitable at the end of the week? This is probably one of the most important things that we're going to look at as part of today's webinar. Point number 5, before we go on to the next slide. So the success rate and the reward to risk ratio, what is it exactly? So the success rate is the percentage of the trades that you are closing in a profit. Okay, so let's say that this week I opened 10 trades and closed 10 trades, and I left no trades open. Okay, so 10 trades were opened, 10 trades were closed. If 7 of those 10 trades I closed in a profit and 3 I closed in a loss, we're looking at 7 over 10. So we've got a 70% success rate. If 5 of those 10 trades were closed in a profit, then we have a 50% success rate. Very simple to understand. The success rate is the percentage of trades that week, that week and that month and that year, depends on, of course, your experience, that you are closing in a profit. The reward to risk ratio is equally as important, and we're going to be looking at how you can refer to the two and the trade journal in order to determine what type of setup you need in order to be successful. Reward to risk ratio, how much are you risking per dollar that you are aiming to make? So if somebody knows, because we've got a lot of beginner traders, some people may not know, it's nothing advanced, so something very simple. Some people may know the stop loss and the take profit. Some people may be using trailing take profits and trailing stop losses. The same thing applies. There, an individual is putting certain prices within the market where they say, if it hits this price, I'm not willing to risk more. If it hits this price, I want to cash in my profit. So this is the reward to risk ratio in very simple terms, because you're saying to yourself, I want to risk, let's say $10, and my take profit is at $100. So this is a reward to risk ratio. You've got 10 over, the ratio is 10 to, was actually 100 to 10. So the reward to risk ratio is very simply 10 to 1. It's very simple. This is what the reward to risk ratio. Per $1, how much are you risking? Now, I've got a question here. It's a very good question. I've read up a lot about the reward to risk ratio. A lot of people say that it should be as high as possible. Some websites, misspelled. Some websites recommend a 1 to 3 ratio. Some websites recommend the 1 to 4 ratio. Ladies and gentlemen, this is where a lot of information online becomes incorrect and can mislead individuals. It's not about the correct reward to risk ratio. You know, some people can say the higher the reward to risk ratio is, the better. If you've got a reward to risk ratio of 20 to 1, that's the best thing. If you've got a reward to risk ratio of 50 to 1, that's even better. It's not about that. It is about ensuring that the reward to risk ratio, in accordance with your trading and in accordance with your success rate, is going to make you a profitable trader. So this is the most important thing. So some people may say, how do I know if my reward to risk ratio, so somebody's asked another question, is 10 to 1 and 1 to 10 the same thing? It's just, it depends. Some people refer to reward to risk ratio and some people refer to risk to reward ratio, but generally speaking, yes, it is the same thing. So what was I saying? It's not about the higher the reward to risk ratio, the better. It's about making sure that in accordance to your success rates and your trading, it is going to make you mathematically, based on mathematics, it's going to make you a successful trader. That's the most important thing. It's not simple, but in the later slide, if people bear with me, in the later slide, I will give you some examples. So improve your trade and trading plan. We're not going to look into too much detail in terms of your trading journal. It's very simple. You're just noting your trades. You can also, there's different trade journals that we're going to look at later on, but we're not going to look at, for example, and spend hours and hours looking at trade journals because it's very simple. You're noting your trades, when you opened, why you opened, what you opened, when you closed, and why you're doing it. And of course, the most important thing is your what is happening before and after your trade, and using the trade journal to determine your success rate. This is the most important thing, ladies and gentlemen. So these are some of the questions that you need to be asking yourself when you're noting the trade journal. Where are your trades going wrong? So going back and looking at those trades that at the end of the week you've closed in a loss, and you go back and you say to yourself, why did I open that trade? This trade was in a loss. I lost $50 on this trade. Why did I open this trade? Is it because of news? Okay, if it's because of news, because we've had a lot of news over the past 2 weeks. If it's because of news, and I look at this week and I said, every single time I'm trading when there's news, I'm closing the trade in a loss. Maybe if that's the scenario, maybe I need to avoid trading when there's significant news. This is just an example. Maybe the other scenario, maybe every time you're profitable is during news. So maybe you should be trading news more often. But it's going back and reviewing this. Can you increase your take profit on your successful trades? So go back to all of your successful trades. So for example, let's say we're looking at individuals that are looking to trade the trend, and the trend looks something like this. Okay, this is the trend over the past 24 hours. Over the past 24 hours, I opened 3 trades. So I opened the trade here and I closed the trade here. I opened the trade here and I closed the trade here. I opened the trade here and I closed the trade here. Now, if I went back and I reviewed the past 24 hours, I can very clearly see I'm closing the trade too early. Now, I'm not saying, ladies and gentlemen, you're going to open a trade here, keep it open and attempt to close it here. Okay, we've looked at a webinar a couple of months ago, which was great in terms of this, and looked at exactly what percentage you should be looking to aim for. The percentage after certain price movement strategies advise that potentially you should be speculating in a certain direction, but we're not going to look into that as part of today's webinar. But of course, you're not going to aim to take advantage of the whole wave. If you are, believe me, you won't be able to do it successfully. But of course, you need to look at if there's some leeway to keep the trade open slightly further. And if you can see here, I could have opened the trade, kept the trade open longer. Here, I could have kept the trade open longer. And here again, I could have kept the trade open longer. Then this is a scenario, for example, where we can look at maybe slightly increasing your take profit. Doesn't mean you're increasing your risk, unless you're going to actually turn away from going from a day trader and switching completely to a swing trader. So for example, if it means based on what you're looking at, that instead of keeping trades open for 1 hour, you're going to keep trades open for 1 week, then of course you are indeed increasing your risk. But if you're looking at the actual trade period being more or less the same, but you're just increasing your take profit, then of course you're not increasing your risk necessarily. Review where you wrongly entered certain trades. If you are trading more than one asset, you'll be able to see which asset best suits you. I've got a question. I'll answer this question in a minute because somebody asked me, what is the best asset to be trading? This is actually a question I get asked quite a lot. So I'll answer that question in a moment. The same applies when you're using more than one strategy. So for example, I've got a lot of individuals that I speak to and they say, I've got one account for this strategy, I've got another account for this strategy, and so on and so forth. They may have 4 accounts. Look at a trade journal, and trade journal will show you which is the most profitable, which has the highest success rate, and so on and so forth. Improve consistency in the longer term. You'll be able to see that throughout today's webinar. Why a trade journal will help with that. Assist with forming a trading plan and confirms how the trading plan needs to be altered. So this is what we've been saying so far. Now, somebody asked me a question earlier on. Actually, it was before the webinar even started. Somebody asked me, what is the best trade to be, the best asset to be trading? Now, since I'm mentioning trades here, I will answer the question. Keep in mind, we're not giving financial advice in any way, shape, or form. The best trade, okay, the best asset, ladies and gentlemen, isn't necessarily relevant. Now, some people may say the best asset is the one with the cheapest fees. Makes 100%, it's common sense, makes absolute sense, and that's fine. Some people may prefer to trade the NASDAQ, the pound against the US dollar, the euro USD, trade gold, and so on and so forth, whatever it may be, because it's the cheapest, it has the lowest spread. That's absolutely fine. What I will say though, in terms of assets, is it's not about picking the best assets. Yes, you want to pick the one with the most competitive fees, but it's about only trading one asset. A lot of people that I speak to, they say to me, and again, this is down to you, trading is fully in your power. People say to me, today I'm trading the GBP JPY. Last week I was trading something different. Some people I speak to, they say, this week I'm trading 10 assets or trading 5 assets. Some people say to me, I'm trading 4 free assets. If you keep changing the assets that you are trading, or if you're trading too many assets, trading is harder, okay? It's like, for example, if you're at university, if we've got any students here, for example, if you're at university, you pick 1 degree. You don't pick 5 degrees to study. Puts a lot of pressure on your shoulders, more harder to manage, and your results won't be as good. If you want to study more than 1 degree, most likely you're going to study one and then study the other. The same thing applies to trading. If you trade one asset, it doesn't mean you trade less. It doesn't mean there's less potential profit. Somebody can trade 1 asset and opening 10 trades a week. Somebody can be trading 5 assets and only open 5 trades. So this is something which is extremely important, because if you're trading 1 asset alone, it means that your knowledge in 12 months' time is going to be so much more immense and larger than somebody who keeps trading at different assets every single day and they trade more than 1 asset throughout the day. So this is something which is extremely important. So again, it kind of answers the question. Hopefully people are getting a good idea in terms of what it is I'm trying to say. So analyzing your trade, let's look at this, for example, ladies and gentlemen. This is very similar to the example that we were looking at. Now, this is a scenario where I've got a question here. Somebody says, what percentage of the wave should we be looking at? Guys, this was part of a different webinar. But one of the theories that we looked at is individual state, that one of the theories is the 70%. If you're looking at a trade, an actual impulse wave, you shouldn't be looking at trading very max more than 70% of that impulse wave. Very max. But again, it's part of a different webinar, so I apologize, but I don't want to spend too much time on wave theories. But this is an example, ladies and gentlemen, of, let's say, reviewing today's trades. I'm opening trades at this green line. I'm opening trade here at this green line. Perfectly happy with this. I'm trading in the direction of the trend. We've got higher highs. We have higher lows as well. I'm waiting for the retracement to end. I'm waiting for some momentum, and then I'm entering and speculating the upward price movement. And also I'm closing before the wave loses momentum. So I'm 100% happy. Where is potentially somewhere where I can improve my trade here? I wouldn't say I can necessarily improve my entry. I've waited for some momentum, because of course you don't want to be speculating upwards when the price movement is downwards, because there's other risks there. Of course, if that's your strategy, it's 100% fine for you to do that. But you know, looking at theories, that entry is 100% okay. Whereas when we're looking at our exit, yes, it's profitable, ladies and gentlemen, but could I have kept hold of the trade slightly longer? Now, I'm not going to try and exit the trade here, but for example, I may look to exit the trade here. And the same thing applies here. Could I have kept hold of the trade slightly longer? Now, keep in mind, this isn't a 1 minute chart, in which case that small difference isn't anything major. This could be a 30-minute chart, in which case that difference may be 20 pips, maybe 0.20%, in which case it does make a difference, especially if you're trading with a lot of leverage, ladies and gentlemen. That can make a lot of difference. Somebody's asking if they can get a recording. Yes, of course, everybody will get a recording, 100%. Now let's look at a different scenario. So just keep in mind, the slide has changed here, okay? This time I'm entering in the market here. I'm entering in the market here, and I'm speculating upwards, and I'm speculating upwards. I'm exiting the market here, 100% a great exit point, and I'm exiting the market here. Again, a great exit point. Both trades were profitable, so there's no major issues there, no major issues. But what I will say, though, ladies and gentlemen, is by reviewing these trades, and keep in mind, this is all part of your journal. This is, you've monitored every trade throughout the week, and you're going back and seeing your trades. And we can see that actually I'm entering when the price is declining. Okay, what you could have actually done is waited for some momentum upwards and traded in this area of the market. Again, you've entered here, and the market's maybe moving against you for an hour, maybe it's 2 hours. Doesn't matter, the trade is still profitable, but you could have entered the market here. For example, if you entered the market here, you would have earned more as well, number one, because you're entering at a lower price, and number two, there's a less chance of you trading against the trend or seeing a negative price movement. You don't have to keep your cool and discipline necessarily, because the market is moving against you. As soon as you enter, the market starts to move in your favor. So this is what a trade journal is all about. It's about looking at your trades again to see what alterations that you may need to do. This slide, ladies and gentlemen, one of the most important slides. It is the most important slides of this webinar, and I'll explain exactly why. We are going, and this is slightly more advanced we are going to look at the mathematics and the statistics behind your trading. Now, what do you mean by that? Mathematics and statistics behind your trading. And this is exactly what I was referring to at the beginning. The ability to identify the next price movement is not the most important aspect of trading. It is very important. If you are able to do so, it's going to make trading so much easier. But it's not necessarily the silver lining between a profitable trader and somebody who's not profitable. And I'll explain exactly why. Let's look at 3 scenarios here, okay? And keep in mind, we've got the success rate, we've got the reward to risk ratio. Now we're going to look at a scenario where John opens 30 trades, Jude opens 30 trade, and Mary opens 30 trades. They're all opening the same trade. They're all opening the same trade size. And also keep in mind, when you're trading a journal, when you're trading and keeping and reviewing a journal, management's a lot easier if every single time your trade size is the same. So a trade journal and looking at the mathematics and the statistics behind trading, it's going to be so much harder, if not impossible, if every single time your trade is a different size. So today I've opened 3 trades. One was 1 lot, the other was 2 lot, the other was 3 lot. Tomorrow I've opened 3 trades. One was half a lot, the other was 0.75, and so on and so forth. It's going to be so difficult, it's going to be impossible to look at what you need to do in order to be successful, unless you've got an amazing ability to determine how the market is going to move. In which case, unless you've got a lot of experience and been in the market like me for 10 years, it's unlikely. Of course, you don't need to be in the market 10 years to be able to do so, but you're not going to be able to do so in the first 6 months. So this is why this slide is so important, because until you get to that point where your success rate is very high, you can still look at ways to be potentially profitable. So all 3 traders are opening and closing 30 trades. Now, trader number 1 has a reward to risk ratio of 2 to 1. This is a ratio. So he's looking to profit. So here I'll put profit. He's looking to profit $40, and he's looking to risk $20. Now, based on 30 trades and a success rate of 67. Okay, so let's say 67% of his trades he closes in a profit. So if he's got a 67% success rate, it means 20 trades he closes in a profit, 10 trades he closes in a loss. Now, if you do 20 trades times $40 profit, you've got 800. If you've got 10 trades times 20, you've got 200. And you need to think of it as a business. It's not bad to have a trade that you closed in a loss. It's bad if you just keep it open and let it run or wipe out your account. But if you're closing the trade, it's just an expense. It's not necessarily anything bad. All businesses have expenses. The main thing is that your profit and loss, your P&L, is positive. So we can see here the mathematics. 2 to 1 ratio. He's opening 30 trades. He's got a 67% success rate. That means 20 trades in a profit, 10 trades in a loss. So 800, 200. He's in a profit at the end of the week, $600. Let's look at point number 2. Here we're looking at Jude. He is looking to earn $1. Sorry, he's got a reward to risk ratio of 1 to 5. So this is a negative reward to risk ratio. He's looking to risk more than what he's looking to earn. Okay, so he's looking to earn $10 and he's risking $50. Now, because of that, because it's giving the market more time when the market moves against him, but he only needs a small price movement in order to close the trade in a profit, he actually has a very high success rate, if that makes sense. Success rate is 90%. So this is what I'm referring to before. It doesn't mean you have to have a positive reward to risk ratio. It doesn't mean the higher it is, the better. It's all about, does the reward to risk ratio with your profit and loss per trade, with your success rate, with the number of trades that you are opening, if these figures add up to you being a profitable trader, that's the main thing. So here, for example, we've got 27 trades in a profit, 3 trades in a loss. So his turnover is 270 and his expenses is 150. So he's in a profit 120. He's still a profitable trader, okay? Even though he's got a negative reward to risk ratio. Why? Because he has a very high success rate. Now, if he changes his reward to risk ratio, his success rate may also change. So you have to keep that in mind as well. And then point number 3, example number 3, Mary. First month trading, no experience whatsoever, no ability to determine how the market is going to move. So for example, here is 35% success rate. So no ability to determine how the market is going to move. She's terrible at that. Maybe she's not very good with the volatility. But she has a reward to risk ratio of 4:1, which is very high. So she's looking to earn $32 per trade. And per trade, she's risking 8. Okay, so per trade, she's only got 11 trades in a profit and 19 trades in a loss. So you can see here that she isn't great at trading. More trades are in a loss than there are in a profit. She only has a 35% success rate. But her turnover is 363. And her expenses are 152. So she's in $152 profit. So even though she's got a low success rate, because she has set her reward to risk ratio appropriately, and she's looking at how much she's going to earn per profit and trade, how much she will lose per profit and trade, and as long as all these individuals are strict and keep by it, then of course they're ensuring that they've got profit at the end of the week. And this is only going to happen though if you're true to yourself. If you're going to say to yourself, you've looked at your journal, you've got a 50% success rate, and you're going to say, it was a bad week, normally I have a 60% success rate. You know, you're not looking at reality and this isn't going to work. You have to be true to yourself, you have to be disciplined, and you have to review every single week because your success rate may change. For example, you also keep in mind, if your success rate this week is 70%, next week is 65%, next week is 75%, then you may want to look at an average, or you may want to look at the worst case scenario. Now, most likely, it's very rare you'll have something completely different, like one week with 20% success rate, the next week with 90% success rate. Normally, it's more or less the same. Now, it's up to you. Some people may want to work off the worst success rate. Some people may want to work off the best success rate. And of course, go back and review your trades, review your entering and exit. So for example, here, I'm entering, here, I'm entering, here, I'm entering. I've closed the trade here, in which case I'm close to the end. I'm quite happy with that, to be honest with you. I'm close to the end, but I could have kept hold of the trade slightly longer. Also, I'm quite comfortable with that because the trend continued after. Then I opened the trade here, close the trade here. Here, definitely, I would have wanted to keep the trade open longer. In which case, this wasn't such a great exit point. Same thing applies here. I could have kept hold of the trade longer. So this wasn't a great exit point either. Another thing to note is all of these trades, so 1, 2, 3, would have been in a profit in the longer term. So again, I may potentially go back if there's a reoccurring scenario and say to myself, should I slightly increase my take profit? If I'm looking to earn 30, doesn't mean I'm going to go back and say I'm looking to earn 30, let's try and earn 130 per trade. But I may go back and say I'm looking to earn 30. Let's try and increase slightly to 32. Still profitable, still same scenario next week. Let's increase to 34, and so on and so forth. Got some more questions, so I'll try and answer as many questions as you like. So somebody's gone back and said there was a typo on the previous slide, this slide here. But it's not an issue though, ladies and gentlemen. Either way, all three scenarios are profitable. Doesn't matter if it's 150 or so on and so forth. The main scenario the main thing people need to understand is all of them are profitable, no matter of their success rate. It's all about though looking at the success rate, the amount of trades you're opening, your profit and loss per trade that you're setting. Keep in mind, you set that. You set your stop loss and take profit, and saying to yourself, this is where I need to place myself within the market. This is the trade size I need to be setting. This is where I'm going to set my reward to risk ratio. You're looking at the mathematics behind how you should be trading based on your trades, and you use your trade journal to do so. I've got a lot of people, guys, you don't need to send to me, this is a great webinar, that's amazing. I didn't know that because I'm getting lost in all the questions. So here's a question. By the way, thank you for the feedback, of course. How can I calculate the success rate? Go to your history on your MT5, look at how many trades you opened this week, and look at how many of those you closed in a profit, how many of those you closed in a loss. So for example, if you opened 100 trades in January, out of those 100 trades in January, 68 you had in a profit and 32 you had in a loss. That means you have a 68% success rate. So you're just dividing one by the other, okay? So it's very simple to how to calculate your success rate. Price, condition, and traditional price movement. Trade journal can help on this as well. A lot of people do this, especially beginners. You don't have to do it, but beginners do it quite a lot, where they use a journal, they look at a journal which is slightly like this, and they color coordinate it. So for example, they'll have an asset and they'll color coordinate every day if it's profitable, not profitable, if it's higher, lower, and how much higher and lower it is. Because what people start to see is there's patterns. That doesn't mean you're going to trade solely based on this, but it does slightly help you. Because for example, and an experienced trader, for example, like myself, I don't need to have this trade journal because I know, if I'm every single day seeing higher and higher and a higher price, people will start to cash in on, if it's happened for example, this is just an example. If it's happened for 3 days, I know on that 4th or 5th day, people will start to cash in. But for beginner traders, they can look at a trade journal for this as well. So there's not only trade journals looking at your trades, but there's also trade journals for your asset. Now, something else you can do is look at a trade journal for correlations. So for example, there's very well-known correlations with the NASDAQ and with other stock markets, the US bond yields and the US dollar. So what are the correlations? A lot of the time, if global stocks, so the DAX, the CAC, the Nikkei 225, and so on and so forth, if global stocks are increasing, so will the NASDAQ. If they're decreasing, the NASDAQ will as well. Because of course, it's the global investor sentiment. Also, there's correlations with the US dollar. The dollar's up, there's a higher possibility of the NASDAQ declining. And there's correlations with also yields. If yields are up, the NASDAQ has a high possibility of declining. It's not always the scenario. Good examples today. Bond yields are down and the NASDAQ is down. So it's not always the scenario. It's a correlation though. You can use a journal also to keep an eye on this. Today, both were down. Was the correlation correct? If so, put a yes, make it green. Next day, do the same thing. If you find every single day it's green, you'll see a pattern there. This month, under the current market conditions, it is having this effect. If you see all of it's red, slash it. It's not currently having an effect on the market. I've got an individual here. I could not attend the Auto Charters webinar. I registered last week on Wednesday. I really want to watch the webinar recording. I am by the send the link. So this gentleman who wants a recording of a previous webinar, go onto our website, go to the live chat, and ask the support team to send you the recording. They will send you the link to the recording. You'll see the live chat on the bottom right. Alternatively, you can send us an email, and again, we will 100% send you the recording. Another journal, this is the last journal that we'll look at. It's also the last slide because we've been speaking for 45 minutes now. Don't want to spend that too much of everybody's time. But of course, we will have more and more webinars. So this, ladies and gentlemen, is looking at a journal of price action. Okay, very important. It's actually very, very important. This is really going to help traders as well, because a lot of people say, you know, I know it's an upward trend. I know it's an upward trend. I don't need somebody to tell me it's an upward trend. I know it's going to end at this price, but you know, let's say the price is here, okay, and I believe the price is going to go up to here. I know that's going to happen, but when is there going to be the upward price movement? When is there going to be the downward price movement? So as the price starts moving up, how do I know where it's going to go to? How do I know it's going to go to here? Okay, and let's say when the price goes to here and it starts to decline, okay, I know there's a retracement. Okay, how do I know when the retracement will lose momentum and start moving up again? How do I know it's going to go to here and then start to move up? This is very important. Okay, and so on and so forth. And this is where the trade journal comes in. This is a price movement. This is the US dollar against the Australian dollar, one of the most traded currency pairs. I think it's the 5th most traded currency pair off the top of my head, maybe the 6th or 7th, but it's in the top 10 100%. There was no news until here, so keep in mind this price movement here and this price movement here is related to news. So this is why this is slightly higher price movement. Now, what I'm doing is I'm looking at all waves, okay, and I'm measuring the waves. And you can measure a wave on the MT5. Very simply, you'll see there's a cross tool on the MT5 in the middle, more or less above. And you click and drag and it will measure you how much the price has moved. So I'm measuring all waves. So this is wave number 1 and I've measured it. And the wave is 0.27. The next wave is this wave here, is 0.18. The next wave is here, well, actually the wave goes all the way down to here. So this only moved up for 2 candlesticks, not enough for me. So I ignored that and I measured this whole price movement here. It increased by 0.30, it declined by 0.30. Next, here to here, 0.31. Next, here to here, 0.42. And then I also measured the upward price movement. So this price movement here, this price movement here, this price movement here. I'm measuring all price movement. Now, what this is saying to me is I'm getting a good understanding of the price action. So I know, you know, if we get a big price movement downwards in favor of the trend, I know, let's say, for example, I may be using an oscillator. The oscillator may say to me, it's too cheap. So I know we're going to get an upward price movement. How do I know that it's going to move up to this price before it happens? How do I know that it could go to anywhere between here and here? Because I'm measuring all of these price movements here. Now, if we ignore this one here, because it's related to news, now you may want to ignore it, you may not. But if we do, here, ladies and gentlemen, you can see 0.19, 0.14, 0.15, they're more or less the same. Okay, nobody's measuring them. Okay, a lot of beginner traders, they don't measure them. So I know, even before the movement happens, that if it's going to move up, it will move up to that region there. And then after it goes up to that region, how do I know that it's going to go down to here? Because I'm measuring all of these. Ladies and gentlemen, all of these, I'm measuring them. Now, again, if we ignore this one, which is way out, okay, all of these here, okay, all of these 4 figures here are very similar, okay? very, very similar. So what I'm making a note of them. So I'm making a note of the largest, the weakest, and I'm making a note of the average. Now, the most important is the average, okay? Because that's giving me the average. That's basically saying to me, this is the highest possibility of what's going to happen if the price movement happens. Now, some people, now on the average, I've got two averages. This one is the average if I take into consideration this price movement here where there was news. Some people don't trade during news, so they may not use that as part of the average. This is taken into consideration the average without taking into consideration the news. The same thing applies here. This is a larger price movement because larger average because it took into consideration volatility during news. This was without. But nonetheless, if we're looking at the average here, 0.27, you can see if we're looking at this price movement here, it's very, very close. Now, some people may be looking at an ultra risk, low risk appetite. They really scared of trading. They really want to trade as safe as possible and avoid as much risk as possible. What individuals can do is not look at the average. This is completely down to you guys, by the way. And instead of looking at the average, look at the weakest, okay? So even if you're trading this, okay, yes, you're going to exit earlier, but it's still profitable. Even if you're trading this, you're still profitable. Even if you're trading this, you're still profitable. So this is something else I will say. The next thing I will say is, this is measuring all of the price movement. You're not, of course, going to be able to pinpoint. You're not going to be able to say, I need to buy here, sorry, sell here, and I need to close a trade here. I need to sell here, and I need to close the trade here. You're not going to be that perfect in your entry and exit. So you can't take advantage of the full trade. So if the price movement is 0.18%, you may say, I'm going to look to trade 50% of that, okay? Because you're probably going to be entering here and probably exiting here, just as an example. So hopefully that was also helpful. This is also part of the trade journal, but a different type of journal. So that brings us to the end of today's webinar. I've been speaking now for almost 50 minutes, not quite yet 50 minutes. Actually slightly more than 50 minutes, I do apologize. So let's end today's webinar. Trade safe, trade responsibly. Cannot see any other questions. I've got two questions at the very beginning, but they asked me if I can send the answer privately. So maybe they were slightly shy. So absolutely 100% okay. If anybody has any questions, feel free to ask now. I'll leave the webinar open for a couple of seconds, see if anybody has questions. Otherwise, we'll end. So I can't see any questions. So let's, ladies and gentlemen, end today's webinar. Trade safe, trade responsibly, and hopefully we'll see you very, very soon. In the meantime, goodbye. I've got a question. Can I get the PDF? Again, contact support, and they will give you the PDF 100%. Goodbye, ladies and gentlemen. Enjoy the rest of your evening.